Hello investors and traders, and welcome to the weekly market report with the market guys. I'm AJ Monty. This is a 1-year daily candle chart of the Dow Jones Industrial Average ETF, ticker symbol DIA. And as I usually do about 90% of the time, is I've left my lines on the chart from the previous report so you can see how things have played out. And if I zoom in here, you'll see that this in fact was the forecasted trend line that I have had in place really now for a couple of weeks, and the Dow has been following that line quite nicely, with this lower horizontal line being the support level. So my forecast was that we would pull lower towards support, and along the way you can see that the volume has been increasing down here. You see, if the volume is increasing in the direction of the trend, it means that the trend is getting stronger. But there's a couple of things that have come up, especially yesterday on the 5th of June. We had a negative candle, so the market was down, but the volume has dropped by about 20% from the previous day. So that's telling us that the sellers are starting to get tired. They're maybe running out of shares to sell in their position. Whatever the case, the downward leg is now starting to weaken. So what I'm going to do is I'm going to erase this line, and I'm going to put a new forecast in what I think could happen next week. In fact, I think maybe we can go just a little bit lower, not much, but eventually I think we're going to move back up in an attempt to bounce off of this support level. And again, the volume is the key leading indicator, which is why I'm making my shift in the shorter term leg. Overall, the big picture is I'm still very bearish. But remember, in major trends or longer term trends, there's always a series of smaller or minor trends that we call legs. And this, in fact, is what I'm forecasting each and every week, is the up and down legs. So be prepared for maybe some mixed signals next week as we change direction. The near-term resistance for the Dow is going to be up here right around 182, so I'll leave that in place, and now we're stuck in a trading range. So that's the Dow. If I look at the S&P, this is the S&P ETF, also known as the spiders. Again, these lines are up there from last week, and we followed that leg perfectly. I did forecast that we would break down below the triangle line. We did, and if you'd like, you can even go back to our Market Guys website and listen to the archived session. I always encourage people to do that because it's really a great way to learn how to forecast trends and charts by looking at the candle patterns. But your lesson really is to manage risk using these tools. So if we think that the market is going to rally from this point, then you might want to at least move your stops up, or maybe even add to short-term positions that are more bullish. But you're using the charts as a tool to manage risk and put the odds in your favor. So here again, the market did break down below the bottom triangle, and we see here, I'll have to zoom in a little bit more for you. As I zoom in, you'll see this candle from Friday, June 5th, is known as a spinning top. Spinning tops and dojis, which are like crosses, those usually occur or show up during pivot points. These are signs of indecision. So again, the trend or the leg was down, the volume was more or less increasing, but on Friday the 5th, we had about a 15% drop in volume as the doji shows up. So what am I going to do? I'm now going to erase all lines and redraw them so you can see what we are going to expect for next week. This, in fact, is still a trend line or support level that we could use by connecting those lows. See how I did that? I just basically eyeballed as many of these lows and got as close to them as possible. It doesn't have to be perfect. and I see that we could also draw a downward triangle. But what I'm going to do is I'm going to leave this in place, and I'm going to draw a horizontal line from this resistance high right around 214 right there. Now, my forecast is going to be, I think that we're going to bounce off of this trend line and go higher on its way to possibly test resistance. I'm not going to go too high because we're going to have to watch the volume as the market starts to pivot up. We might see a spike in volume, and then as the prices go up, if we see drops in volume, then that means the short-term bounce is going to be just that. It's going to be short-lived. So again, very short-term shift to the upside, but long-term is going to be bearish. And here's why. I just need to pause here and show you why long-term I'm bearish. This is the S&P for 20 years. This is a 20-year S&P chart. And each one of these candles represents 1 month. Look at the dramatic rally and the bull market that we've had. This has lasted since 2009, the beginning of 2009. So we're in this now for just about 6 years. That is one of the longest trends we've had in decades, and it only makes sense to think that we're going to pull back and retrace or correct some of that gap. We've seen that over and over again. The angles of these trends or bull markets have been very consistent. Look at the angle. If I took a protractor here, you can see that the angle is very similar and only off by maybe a couple of degrees when we're, again, measuring the steepness of these angles. But periodically and even cyclically, we are pulling back to pull 50% or even 100% retracements of those trends. I'm being very conservative when I say, okay, I think we could see a 40% or a 35% retracement year, because that's what history has shown us. The other thing is, during this long 6-year trend that we've had, the volume has been steadily dropping. In fact, the volume has been accelerating to the downside. This is a fanning effect that we normally do when we're measuring accelerations or decelerations of these trends, and that's another reason why I think long term we're going to pull back. So that's what we're looking at on the spiders. If we look at the Qs, this is the NASDAQ market, again on a 20-year trend, you'll see that this is, again, one of the longest bull markets we've had in a long time. Look at the steepness of that angle. Look at that trend. Again, we're long overdue for a correction. In fact, if you look at the volume as compared to that trend, this is even a more dramatic drop in the volume when compared to the Dow, the S&P. So, yes, long term, be very, very careful. I think a correction is in order. And don't fear that, please. We can make a lot of money on the way down if you position yourself correctly, because there's so many different ways to make money now in a bearish market. We have bearish or contra ETFs, we have options, we have different indices, or I should say commodities that even work contrary to the major markets. And so there's no need to fear and say, oh, I'm going to move into cash and stay there because I don't know what to do. There's a lot that you can do. Finally, before I go off the 20-year chart on the Qs, you can see that we are approaching a 20-year resistance high from back here in February of 2000. As I zoom into the Qs and look at the more daily chart, then you can see, once again, those lines were left for last week. We did exactly as I said we would. We pulled up to the resistance line that I drew, and then I forecasted a downward pullback. That, in fact, has happened, and lo and behold, like the other two indices that we looked at, we have a spinning top on 15 to 20% lower volume. So I'm going to erase these lines as well, redraw those for you so you can see how to draw trend lines, and I'm going to more or less just take these lows and with my pencil try to draw or come close to as many of these lows, including this, and I'll adjust a little bit to capture these and maybe this low, and then I project out, and I'm going to go right there and drop it. You see, don't worry about this shadow or that line breaching the trend line. It's not an exact science. It's a general area of support that we're measuring. So because of the spinning top and the volume drop, I think we're going to see a little bit of a bounce. I'll leave that right there and leave that in place. So if you do decide to buy any of the NASDAQ stocks for a short-term swing trade or even a day trade, make sure that you're putting your stop somewhere below this trend line, which is now acting as support. And finally, the Russell 2000 has given us the most positive, I should say, out of the other indices that I've shown you. And here's why. We did, in fact, hold resistance. We did pull back a little bit according to my trend line. But on Friday the 5th, we're showing a bullish engulfing pattern, which is very interesting. Let me erase these lines so I could show you what we need to do now after a bullish engulfing pattern. 80% of the time after a bullish engulfing pattern shows, the market will rally. Again, 80% is not 100%, but 80% of the time the market rallies. I'm not getting too aggressive here because of the lows being so perfect, more or less, in that trend, and the bullish engulfing pattern showing bullish indications. But we do have major resistance areas in the Russell 2000 that we have to watch out for. So I think is going to happen is I think the Russell 2000 is going to rally in an attempt to retest that resistance. Then we're going to have to look at the signals and analyze the volume as compared to the move before we make our next move to forecast the next up or down leg. Finally, the VIX. The volatility index is showing bullish signs for the S&P. And if you follow the VIX, you'll know that it's a contrarian indicator. Once again, the VIX did exactly as I thought it would. It moved up nicely to this line right here, which is my forecasted trend. But the VIX is showing a bearish engulfing pattern. Remember, the VIX is a contrarian indicator. So if the VIX goes down, the S&P will rally. And we've already looked at those charts to determine that the shorter term leg could be up next week. Now, another thing you have to look at on the VIX, and this is where I'm going to put my target, there's a gap down here. Very rarely do the gaps stay open. In the VIX, almost 100% of the gaps fill. It's not 80%, it's close to 100%. So with this bearish engulfing pattern, I'm expecting the VIX to pull back, fill that gap, and then we'll see a bounce from the gap. That's my forecast for the VIX. So the VIX has been supporting the volume that we looked at, the dojis that are pivot points. It looked at the condition of the major indices as a whole. So again, short term, we're looking for a bounce, but we're going to protect just in case it does not go up. We want to make sure that we're getting out with minimal loss if the markets move opposite from what we expect. And if you're interested in getting more information from the Market Guys, feel free to visit us at themarketguys.com. We load that up with free information, video links, educational tools, and such. The library here is filled with information. The rubber band effect is something that's nice to look at. 1% rule, always a must in learning how to manage risk. And of course, trading the gap, which is what I just mentioned in the VIX. So you might want to take a look at that. These are very short, 5 to 7 minute videos that you can really absorb as your daily financial vitamin. So that's it for now. I'm AJ Monty of the Market Guys. I look forward to speaking with you again next week. So stay tuned, visit our website, and keep your stops in place. So long.